If my forecast is right on where rates go, by the way, I see the long bond is going to deliver you a total return this year of 20%. I frankly don't think that there is a legitimate scenario that will get the equity market there this year.
2023 is kicking off with a guest who's going to get us into three very different sectors. David Rosenberg, founder and president of Rosenberg Research. Thank you very much for joining us on Three Ideas. Before we get into your three ideas, I just want to start with your global macro outlook, because this is really the foundation of the three ideas we're going to talk about today.
Well, I think in one word or less, recession is going to be the operative word for 2023. I think that we move beyond the debate of this being a soft landing to recession. I think now the question is going to be how deep and how long. And it was interesting to me to see last week the big banks coming out and saying that they're expecting a mild recession. Even if it's mild, I don't think that there's a lot of asset classes out there that are still priced for a mild recession. I think that especially after this big risk-on rally so far this year, for some reason everybody's got soft landing back on the brain. The overall theme is this: it's basically 2022 was the year of the aggressive interest rate actions from the central banks led by the Fed. 2023 will be the year where the lags from those interest rate hikes percolate through the economy, earnings, and cash flows. It's going to be a rough year. If the Fed sees what I see and they start cutting rates and re-steepen the yield curve in the second half of the year, 2024 is going to be a different story. But this year is going to be an equally rough year as last year for risk-on investors, especially in the equity market, but for different reasons. It won't be so much the multiple contraction this time. It'll be the outright earnings recession.
And the length and depth of a recession, are you on the same page as the banks you mentioned?
Well, they didn't really give a timeline. I think everybody is hoping for transitory. So I think that it's difficult to pinpoint how many quarters this recession is going to be. A lot is going to depend on the Fed's reaction function. The longer the Fed drags its heels, the longer it remains consumed by inflation fear, and the longer that the yield curve stays inverted, the deeper and longer this recession is going to be. My sense is that, if a plain vanilla recession is usually 2 to 3 quarters, and usually GDP might go down, roughly 2%, I'm not so concerned about the peak to trough decline in GDP. So much of GDP is insulated from recessions, healthcare, education, utilities, shelter. You need to have a real humdinger of a decline in cyclical spending to cause a gut-wrenching decline in GDP like we had back in 08 and 09. That's a one-in-a-century event. My big concern is that this is going to probably last longer than people think. I'm more concerned about the duration of the recession than the magnitude, and that once we get out of it, I think the recovery is going to be very subdued. For the people that believe in the higher for longer interest rate thesis, means that the Fed is not going to ease policy as much as they should. You don't get much of a recovery out of that. So I'm taking a big picture view here for the next several years. People ask the question, as you did, so we get a recession, what does it look like? I'm also thinking not just a recession, what does it look like, but what does the inevitable recovery look like? And I think it's going to be a series of small case W's. And I say that because there's just not a lot of pent-up demand right now. There might be pent-up demand in China. That's a different story. But in the U.S., we just basically, lumped in a whole cycle of goods-related spending in a short period of time because of the pandemic, the lockdowns, but all the stimulus checks. It just created one giant distortion in the economy. And there's going to be a long-term payback for that. And I know that people say, well, we're still service-driven, and that much is true, although a lot of the reopening trade that's benefited travel and tourism and restaurants and hotels and the like and theme parks, that's already played out. There's not a lot of extra impetus from that. But we front-loaded so much consumption of stuff because of the pandemic and because of the fiscal policy that we had. long-term payback from that. So it's not just the recession, it's what's the longer range outlook for U.S. economic growth. I'd have to say it's very tepid.
And that front ending of the spending that you were just referencing, is that why you seem rather firm on the notion that that inflation will melt away in 2023?
I'm absolutely convinced that inflation is going to fall. It's going to fall faster than people think. I know that we talk about inflation. It's a process. It's like it's a race between watching grass grow and paint dry. But I think that the conditions are in place for inflation to decline materially. Now, a lot of people talk about, well, we have deglobalization and the return of labor power, although I don't really see that. But let's wait and see what the longer range outlook for inflation is. I think that there's a lot of assumptions that go into that. Let's just take a look at what we know staring us in the face. We know that when you're going to forecast inflation, and I'm going to talk a bit like an economics professor right now, but the first thing they teach you in economics school is about supply and demand. Because if you don't have a supply and demand curve, you can't forecast the price of anything. So we're talking about, say, consumer prices, the consumer price index. And the one thing that really strikes me is this, is that in the 3 years since COVID entered our lives, real GDP growth has averaged less than 2% at an annual rate. That includes the pandemic, the early stages of the pandemic, the lockdowns, all the stimulus, the reopening, and then last year's very weak economic performance. Over the past 3 years, real GDP growth, and GDP is aggregate demand. GDP is all about spending. It's averaged less than 2% at an annual rate. And what was real GDP growth in the 3 years leading up to COVID was 2% at an annual rate. And this is a message for all the people that say we're back into the 1970s. Why? Why is that the case? In the 1970s, the first of the boomers were in their 20s, loading up on homes and autos, refrigerators, appliances, electronics. The first of the boomers are in their 70s today. It's a totally different demographic. In the 1970s, when people talk about the inflation in the 1970s, it wasn't just about union power and about sclerotic government policy. When we weren't in recession, when we were not in recession, and for 3/4 of the time in the horrible 1970s, the economy was actually expanding. Okay, and aggregate demand growth was running at over a 5% annual rate. When was the last time that happened? And that's because we had very vibrant demographics. We could argue about government policy, and we could argue about coming off the gold standard, and we could talk about trade unions and wage spirals, but we had actually tremendous real demand growth in the 1970s. When was the last time we had 5%? So I'm trying to say here that we had 2% growth in demand in the 3 years leading up to COVID. And in the 3 years after, we've actually averaged less than 2%. And all I hear is inflation on everybody's brain because people just can't seem to see past the tip of their nose. And it's just human nature to extrapolate your most recent experience into the future, which is a very dangerous mistake to make. So here's what happened. We have weaker demand growth, even with all that stimulus, all the stimulus checks. And the reopening trade and the vaccines, we've actually averaged weaker demand growth, and yet inflation today in the United States sits just over 6%. We peaked at over 9%. Before COVID, it was 2%. So let's get this story straight. We actually have inflation at 6% with weaker demand growth than we did pre-COVID when inflation was 2%. So what does that tell you? It tells you something about the supply curve, that we got hit with these recurring inflationary shocks from the supply side, not the demand side. And that was because of the COVID. It was because of China's approach to COVID, which elongated this process of dysfunctional global supply chains. And then, of course, we had something unexpected exactly a year ago, which is this Russian invasion of Ukraine, and we know that wars are inflationary. And so that's really what the story has been, these series of recurring supply shocks in the context of demand that actually was more subdued today than it was when inflation was last at 2%. So I don't know about you, I'm just looking at the data. You see, this is not an opinion-based inflation forecast. I'm not making some assumptions about deglobalization or assumptions about the labor force participation rate and people not going back to work. I'm just looking at the facts. And the facts are that when you look on the supply side and you look at the vendor delivery delays, whether it's in the manufacturing indices or the service sector PMI, or you're taking a look at other measures of transportation bottlenecks, they have eased dramatically. In fact, the Baltic Dry Index, which is the poster child for global shipping rates, is not only lower today than it was pre-COVID, it's back to where it was in 1990. I don't see anybody talking about that. The only person I see talking about that is me, but that means I have to go and read my research that I write every day. But what is it that people don't understand? You need a supply and demand framework. Now, what's interesting is that Jay Powell, when he started to raise interest rates in March of last year, at the press conference came right out and said, we are going to be operating policy with a blind eye towards the supply side. Because it was a case of once burnt, twice shy, and we're just too embarrassed and our credibility is at stake. And so even though the Fed was a transitory, the abandoned transitory, even though we all know that 18 months in the overall annals of economic history is transitory, and after being burnt by all the recurring supply shocks, they said, we're not focusing on that. So what's happened is they're focused. This is the most epic tightening cycle since 1981. And of course, Paul Volcker in 81 was focused on the supply side. Well, how do you cure inflation? Is you destroy demand. The situation in the United States and really globally is that the supply chains are actually, the problems there are easing. Transportation costs are also subsiding. And we have commodity prices not collapsing, but off the boil. And all the while, they focused on how are we going to get demand. So what's happening right now is the central banks are trying to crush demand, but not with the same supply curve we had 12 or 24 months ago. The supply curve is becoming actually less inelastic. So when I plot these curves out, which you have to do, inflation's only got one way to go, and it's down. And the latest data are actually showing that the CPI ex rent is starting to deflate. Call it 70% of the CPI is deflating outside of rents. And we know how the rents are calculated by the Bureau of Labor Statistics with these distributive lags. But we're seeing in real time, 4 months in a row, month over month, rents are coming down. This is going to show up in the second half of next year, at a time when all the lags from the commodity price decline and the dollar strength is going to continue to deflate goods prices. And all I hear is, but service sector pricing is sticky. It's sticky. It's sticky. Well, I don't know. There's only two parts of the service sector I'm seeing right now where there's still some pricing power. Accommodation and restaurants. And you're seeing whether it's delivery services, whether it's telecom services, whether it's IT services, education services, medical services, they are starting to decelerate very sharply. And the last man standing is rents, but that's a lagging indicator. So I'm a little concerned that the Fed, instead of it relying on some sort of forward-looking model, is really operating policy on lagging and coincident indicators. And so I think by this time next year, inflation is going to be flat. It could even be negative. And so I think that's going to be the big surprise. It's one of the reasons why I do like long-term bonds, is I think that there's still this resistance, and I love it. I love the resistance to my view, because when that ends, I have to move on to something else. But the surprise, by definition, to the markets will be how far and how fast inflation falls in 2023.
Well, that sets us up perfectly to get into your first idea, which are bonds, specifically U.S. Treasuries. So let's jump into that. It's interesting because obviously I've heard you speak with many outlets, and although this isn't specific to this idea, it's a backdrop that I want to dissect a bit with you, because you say there's no bottom in the stock market absent a meaningful decline in Treasury yield. So before all these folks can be bullish about the stock market, they really need to see where bonds are and where that equilibrium is reestablished. So we'll get to what your view on bonds is in a second, but I just wonder if you can parse that a little clearer for folks, although I think that lays your view out quite clearly about the relationship between the two.
Right. It's otherwise known as the equity risk premium, or the ERP. What, as an investor, are you willing to sacrifice from a safe yield perspective to go into the equity market? So cash is no longer trash. You're getting paid. The Fed is paying you. The Fed is paying you to be in interest rate product. And I find it very interesting that in 2020, 2021, all I was told by the bulls was, don't fight the Fed, don't fight the Fed, don't fight the Fed. But when they cut rates and steepen the yield curve, it's don't fight the Fed. But when they raise rates and invert the yield curve, there's not a peep about not fighting the Fed. So we can get into that in terms of what the Fed wants, but let's just say in terms of what's important for investors, because they say there's no alarm bell at the lows. Nobody's going to be able to pick the day, but there are things that happen at market lows. And at market lows, the stock market doesn't bottom at multiples that are above the historical norm. That just doesn't happen. And right now we're back to the multiple. The forward multiple is almost back to 18. The long run norm is closer to 16. The point I'm making, and then of course on recession earnings, the multiple is really closer to 21. So the point is, what is the equity risk premium? What is that relationship between bonds and stocks, interest rates and stocks at the fundamental bear market lows? Unless you're willing to say it's going to be different this time. And if you want to go with that refrain, I'm not going to stop you. But what happens at the lows is that the equity risk premium typically widens out to 425 basis points. The yield in the stock market over the yield in the bond market over the yield in the stock market. And so that's basically what you have to see. I should say, so the yield in the stock market over the yield in the bond market, that's the compensation that you need to get at the bear market lows. The stock market gets stupid cheap when you get to the trough, especially relative to bonds. So what has to happen is, I think there's more downside to the stock market. Arithmetically, we have to get there. We're basically, I think, barely more than 200 basis points on the ERP. We're halfway there. And so stock market has more work to do on the downside. And if you don't believe that, then bond yields have a lot more work to do. You can't have it both ways. But bond yields have to go down before the stock market bottoms. This happens every single cycle. Every cycle, bond yields go down, and with the lag, the stock market bottoms out. This happened perfectly in 1982. And so what has to happen is a more reasonable relationship between bonds and stocks has to be restored. Now, look, bond yields peaked in October. They're coming down. They'll need a couple of things. They'll need more widespread evidence of the recession, more widespread evidence that inflation is coming down, that the last few months weren't just a fluke. Still a big debate about that. And then, of course, the Fed has to pause, pivot, and then cut rates. And part and parcel of the equity risk premium being restored to a more appropriate level that we see at fundamental market lows. So we should be keeping our history hat on. There's no evidence at any time that the stock market bottoms when the Fed is still raising rates into an inverted yield curve. To me, it's lunacy. I understand what the market's done in January. Okay, that's fine. We had a booming stock market in January of 2018, and look what happened that entire year, and it wasn't even a recession. So we didn't have the Santa rally. Now we're getting the nice January rally. But you need the equity risk premium to pay you, to compensate you to be in equities. If you're an investor, not a trader, if we're talking about getting into the market for the next cycle. On top of that, the Fed has to cut rates and re-steepen the yield curve. There is no evidence of any bottom in the stock market with the yield curve still being inverted. That the yield curve inversion is a very strange thing. It only happens 15% of the time. and it violates the time value of money. But it's the bond market's way of screaming, "Uncle, we're going into recession." And until the Fed re-steepens the yield curve, the recession is not going to end. It comes down to the comment before. So I will be turning bullish on equities when the ERP is 400 basis points plus. I'll be turning bullish on equities when the Fed has cut rates sufficiently, and they will have to cut rates sufficiently unless they want to have us in purgatory to perpetuity. I don't think that's going to happen. The cycle is the cycle. All these centrifugal forces, they're like sine waves, the interest rate cycle, the market cycle, economic cycle, and they all intersect with each other. Interest rates are cyclical. The bond market will push the Fed to cut rates. Okay, the bond market will push the Fed to cut rates. And then it's a matter of when they start to re-steepen the yield curve alongside an ERP of close to 400 basis points. That's going to be a huge bullish signal for me, which I hopefully will be seeing by the end of the year.
Yeah, and I understand quite clearly what you're talking about in terms of the equilibrium between the stock market and bonds. I think what people they've given the parameters, but just in that time horizon for folks saying, okay, if I'm not going to get into stocks just yet, and I want to get into bonds, I just want to be clear about what you see as that time horizon.
Nobody's a perfect market timer. I think that, the way I see it, if you're going to want to turn bullish on equities, and although I have this title or label as the perma bear, I'm dying to turn bullish on stocks. I'll tell you right now, my pledge is that I will be the first one out there with the pom-poms on the sidelines when the time comes. The yield curve has to pivot. The Fed has to pivot the yield curve. That has to happen. So what I'm telling my clients, what I'm telling the viewers here is that there is not a snowball's chance in hell that the stock market puts in a fundamental low, and all these rallies are bear market rallies. There's not a snowball's chance in hell we hit the lows in the stock market in advance of a big rally in bonds. And this happens every cycle. It's just that it's like, Warren Buffett famously said that the thing that we learn from history is that people don't learn from history. Bond yields have to go down, and then they're going to go down the most at the front end of the curve, but the biggest total return will be at the longer end of the curve. Got to re-steepen the yield curve. And not just that, but if you take a look again at the historical pattern of market cycles, the first asset class that goes into the bear market is the first asset class to come out of the bear market. This is true going back 70 years worth of data. The first asset class to go in, it's basically accounting 101. It's FIFO, first in, first out. The treasury market, bear market started in the summer of 2020. The equity bear market started at the end of 2021. And then in the summer of 2022, the commodity bear market started. So treasuries are the first one to come out, and that's exactly what happened. The treasury bear market ended in October. I think that historically in recessions, the Fed cuts the funds rate an average of almost 500 basis points, and in a soft landing, they cut rates 75 basis points. We're not even priced for that. In a hard landing, a recession, they cut rates 500 basis points. And maybe that's one of the reasons why, without telling us, they want to get to 500 to 5% of the funds rate, because they know in the next recession they'll need some bullets. And I don't think they want to go back and re-expand the balance sheet. So maybe this was all, we're going to abandon transitory. We're going to tip the hat to Larry Summers and, to Muhammad Al-Arian, and, we're going to talk about how our credibility has been sacrificed, although there was no evidence looking at the dollar and looking at the tips break-evens. There's no evidence the Fed ever lost credibility, but they played that card, get rates up, and they're going to have a lot more leeway to fight the next recession. Remember the last recession, which we were heading into in any event, even without COVID, it would have been a different sort of recession, but the economy was clearly decaying, and the Fed was cutting rates even before COVID. And the starting point was around, call it 2.5%. The next thing you know, we're in a recession, and they're redoing quantitative easing, which I don't think they want to get back into that game of market manipulation. So they're going to get the funds rate to 5%. I'm trying to say is that historically in a recession, even plain vanilla recessions, not horrific recessions, the Fed cuts the funds rates 500 basis points. Now, people just won't believe that that could ever possibly happen. But I think people at the same time think that we're in some sort of new secular inflationary era, which I don't know why, because of COVID, they think that's going to happen. You know, we had two big shocks very close to each other. We had a global health shock, and we had a war shock, the first shooting war in Europe in 80 years. And the last time we had these two things happen was a century ago. We had World War I first, then we had the Spanish flu. And we had 4 years, not 18 months, 4 years of double-digit inflation, never mind a 9% peak, 4 years of double-digit inflation. But once Spanish flu was in the rearview mirror, once World War I ended, we had a decade of disinflation. And I don't know why people just can't believe it. I understand that things changed, but it was 18 months. And we tend once again just to superimpose the most recent experience into the future. I think the bottom line is that we're going into recession. I'll tell you right now, the Conference Board's leading economic indicator, it goes back to 1959. And when it's down 9 months in a row, as we just seen, you have a recession 100% of the time. I tell people I don't live in a world of 0 or 100. It's always shades of gray. There is no black and white. But I got news for you. This is a pretty black and white call right now. It's basically just a matter of how bad will the recession be. It's not about if we're going to get one, and it may have already started. People will say, well, but look at the job numbers. Well, the household employment numbers haven't been so good. They've been bad for the most part. And the payroll numbers we know are going to be revised. So we don't know. The recession may have already started. But in any event, recession, I think, is close to a done deal. A jeu sans fait, as they say on the Quebec side of the border. And so the Fed cuts rates 500 basis points. Now, maybe they won't go 500 this time. Maybe they're just this Powell Fed is just so Volcker-esque. But they'll be cutting rates a lot. And remember that the neutral funds rate is 2.5%. They want to go to 5, nice round number. They all seem to want to go to 5. That's probably 2 more rate hikes away. But the neutral rate's 2.5. So you see, even to become accommodative, they have to go below 2.5. And you're telling me in the inflation scenario I'm depicting and the economic scenario I'm depicting that they're not going to go below 2.5. They're going to go below 2.5. They're going to go below 2.5. I know it's an impossible story to sell right now, but imagine trying to sell this story back in 2007 into 2008, or imagine trying to sell the story back in 1999 into 2000, 2001. We have to basically continue to drive the bus by looking through the front window. Recession is staring us in the face. We have asset deflation in equities and residential real estate. There's going to be all sorts of knock-on effects. The recession will incur a negative profit cycle that's not priced in, and an impairment of cash flows, not priced in the corporate credit either. So this is going to be a very difficult year. Unemployment's going to go up. Inflation is going to break down. And again, a case where your assumptions drive your conclusions. How does the Fed not cut rates? And they'll have to cut rates 250 basis points from the 5% peak they want to get to just to get to neutral. You see what I mean? Just to get to neutral, they are going to have to cut rates 250 basis points. This is what nobody talks about. You know, I'm still talking to people that think they're going to go to 6%. I'm saying that's like that. Okay, that is lunacy. Okay, they're going to have to go to 2.5 on the funds rate just to get to neutral. But in recessions, I would posit even under Paul Volcker, they don't stop at neutral in the easing cycle. We have to talk about the easing cycle. This tightening cycle is about to end. Why do we want to talk about what's happening now and what's happened in the past? Let's talk about the future. They're going to have to take the funds rate below 2.5% because to cure the recession, unless they want to risk a future of social and economic instability, they will have to. Now, I'm not going to say they're going to go to zero. I'm not going to say they got to recreate quantitative easing. And certainly I hope they don't, but they're going to have to cut rates quite a bit. So the whole curve is going to steepen, and short-term rates will come down. Rates at the front end of the curve will come down the most, but because of the convexity, because of the price appreciation in your bonds, the long end, dare I say, I would say 30-year zeros will be where you want to be. If my forecast is right on where rates go, by the way, I say the long bond is going to deliver you a total return this year of 20%. I frankly don't think that there is a legitimate scenario that will get the equity market there this year.
I want to jump into your second trade, which are defense stocks. And you say not just simply focusing on the US and Ukraine, that's kind of the obvious, but you looked at other places like Japan and the type of aerospace defense spending that you see going on. So I'm thinking of ETFs like Direction, DFEN. You have iShares, US Aerospace and Defense, which is the ETF from BlackRock, perhaps the best known in this space, ITA, respectively up 67% and 21% in the past 3 months. Walk us through this trade and this idea for a time horizon for this. Is this a long-term play that you see? Because these are pretty big forces happening, not just in the obvious places.
Well, look, as I said before, we're in the midst still of the first shooting war in Europe in 80 years. And so that is basically something that we have to understand, that was a game changer. And we also have, China is another sore spot globally. Taiwan comes up in conversations. And we have a situation where countries that were pacifist in the past, Japan, Germany, you're starting to see military budgets there expanding in parts of the world that you never would have expected it. We have a Democrat in the White House who's now coming to Congress to get approval for spending increases at the Pentagon. So we're in a troubled world geopolitically. It sounds like a glib remark, but the divisions, the global divisions, a more emboldened Xi Jinping in China, a splintered world, Putin, and this ongoing war, and it's an ongoing war that doesn't seem to end with the Ukraine. And so I think that what's happening is you're seeing politically, when I say pacifist countries moving towards expanding their military budgets, that's a pretty big deal. It's becoming,
like Japan,
more acceptable for governments to expand their military spending, which is something that's pretty new. And what I'm recommending, and of course, the aerospace defense stocks were up last year in a down 19% year for the S&P 500. We've had a nice little pullback so far this year. Of course, it's not right. This year what's worked have been the meme stocks, the concept stocks, Bitcoin. We're back in a silly season. The most heavily shorted stocks have outperformed the index this year by a factor of 6. So this is another one of those very whippy bear market rallies. We had 8 of these last year. So in these whippy rallies, the stuff that makes sense tends to sell off. And so you've got a nice trade back into the group. It is a secular story, as you said. They have earnings visibility. There is secular growth. If you're taking a look at the monthly durable goods data, you'll see that the order books in aerospace defense, they're booming. And they're in an area of the stock market that doesn't have a lot of sensitivity to GDP. And that's what I was saying all along, is that you don't have to be zero weighted in equities. Just be very selective. In a recession, the list narrows a lot. So you want to be mindful of correlations to the economy. I mentioned before, anything related to farm, agriculture, that also has secular dynamics. You could even argue energy is far less cyclical than it's been in the past. Not that it's not cyclical, it is, but much less so. And there's some areas that have, in the commodity space, that have very dynamic supply characteristics because of years of a lack of capital investment. That's all well and good. But the aerospace defense is a small part of the market, but it's got secular growth characteristics, and it's got earnings visibility, and it's a non-correlated with GDP. So if you're going to be in the equity market, believe me, there's going to be worse sectors to be in than this particular part of the S&P.
I've heard you speak about farmland, and just recently here on Real Vision, our viewers will have seen a special that we did on investing in farmland, very much in line with what you've been talking about. But just to underline what you're saying in the aerospace defense trades, I mean, you're talking about an industry that you see already showing signs of not having ties to the economic cycle, and is really all about government spending at the end of the day. That's what's driving this, regardless of what's happening in that cycle.
100%. And look, a lot of these, and I like the U.S. market the most because they're the ones that are getting contracts, not just from the Pentagon, but also internationally. And look, this is a big change. When Japan starts to expand its military budget, that's a really big deal. And of course, it's all related not just to what's happening in Russia. I mean, we're seeing as well what's happening across Europe in this particular regard. Expanding military budgets is nothing really new in the United States, although it is taking on a head of steam with a democratic government. You're seeing it in Europe because of what's happening in Russia, but you're seeing because of what's happened with North Korea or what's happening with China, the era of pacifism is over. Now, I'm not a warmonger. Okay, but the best defense is a good defense, and I think governments are figuring that out. So, I think that's an area that people have to understand that in a horrible year for the stock market last year, this particular segment held up very well for the exact reasons that I'm talking about. And it's because it's not correlated with interest rates. Last year was about interest rates, and it's not correlated with recessions, and this coming year is going to be a recession. So you're right, it's a captive market in the sense that the biggest customer is the government. But we know where government spending is going in this regard, and it's a big tailwind for this sector.
And getting into your third and final idea, gold, you're bullish on. Of course, if we step back, we look at gold in October of last year, 2022, going from about $1,600 an ounce then to about $1,900 an ounce now. And prepping for this, I'm looking at the U.S. Global Go Gold and Precious Metals Metal Miners ETF. The very first edition of Three Ideas, we had Larry Lepard on. I would encourage people to go back and look at that Three Ideas episode. He was talking very long-term play, 2 to 5 years, on Equinox Gold, Osisko Mining, Guanajuato Silver, a lot of Canada and Mexico in those plays. So I'm sure they're quite familiar to you, Mr. Rosenberg. But I mean, I think you're just looking at simply GLD. So I want to step back and get your view here.
Great. Well, look, just remember, only my kids call me Mr. Rosenberg. You can call me Dave.
Absolutely.
So I think that, look, the last quotes trade that I did, it's more than a trade, is I bought physical gold. I bought gold coins at the Royal Canadian Mint in Ottawa and had it put away in the vault. So you can buy gold coins, gold bars, you could buy GLD, you can buy whoever your favorite gold miner is. You want the optionality, the juniors are always a great place to be if you have ice in your veins. It's all part of the same trade. So I would just say that there's two things I'm looking at from this bullish view on gold. The first is that, I should say three. The first is that I believe the Fed's going to be cutting interest rates. That's central to the thesis for two reasons. It's because gold is inversely correlated with interest rates, especially real interest rates. And real interest rates tend to go down when the Fed is easing policy. I think that's going to be a central theme, at least through the second half of this year into 2024. Fed is going to pause, then pivot, and there's nothing bad about it, nothing abnormal about it. The risk is that they're going to wait too long, but rates come down, gold goes up, full stop. On top of that, what else is happening is that other central banks are playing catch up to the Fed. The Fed is at the very mature stages of its tightening cycle, but the ECB is not. The Bank of England is not. The BOJ is not. So these central banks will be raising rates long after the Fed goes on hold. What does that mean? It means interest rate differentials will work against the US dollar. The US dollar having already peaked, and it's not going to be a pernicious bear market in the greenback, but a new bear market in the US dollar has already arrived. And it's going to be accentuated by the relative shifts in monetary policy because these central banks have lagged the Fed. Now they're going to play catch up. The dollar's going to go down, and the purest hedge against a weaker US dollar is gold. And then on top of that, the fact that crypto has now been exposed as being far too volatile to be part of anybody's asset mix. Taking a look at what all these different cryptos have done, they're fun to trade. They're not real investments. They're currencies. And you could actually say that gold is also a form of a currency. But as we've seen with Bitcoin and crypto exposed, I'm not talking about the application in terms of blockchain technology. I'm talking about for so many years, people are saying to me, how much Bitcoin should I own in my portfolio? But I would say it's a currency. You don't come to me and ask me how many Swiss francs you should have in your portfolio or British sterling. You're talking to me about a currency as part of your investments that generates no cash flow. Now, it's admittedly, gold doesn't generate a cash flow. It's a gold mining stock certainly generate a cash flow. That much is true. But we're talking about ultimately the gold mining stocks are going to be priced off what gold does. And we did this analysis when Bitcoin was in its heyday, which wasn't that long ago, that the flows, the ETF flows into Bitcoin and crypto shaved about 10% off of the price of gold. And now I think that's reversed. Now that people realize that gold has more stable characteristics, gold doesn't go up or down 20 or 30% in a few weeks or a few months. And so I think that reversal of the outflows to inflows is going to benefit gold as well. But that's secondary to the two fundamental relationships. Lower real rates and a lower dollar means a higher gold price. And that is central to my thesis for the coming 12 months. It's an area, how you want to express it, different ways, as you had mentioned. But it all comes down to what's your view on the gold price. I think gold is going to be going to new highs in the coming months and quarters.
And my favorite part of the show is always ask people what would make you upend your view. I mean, the obvious answer here is if the Fed doesn't cut rates and for some reason continues to raise rates, I assume that would totally alter your view on gold.
Yeah, there's no doubt that if the Fed continues to raise rates, it's negative for gold, and it means the U.S. dollar is going to go back up. And so I'd say that's, again, this is always a case, right? The assumptions drive your investment thesis and your conclusions. My assumption is that we have a recession, the Fed cuts rates, and that has a beneficial impact on gold on its own. And then the cherry on the cake is that the US dollar goes down as well. But look, if for whatever reason, this economy miraculously just turns around and we get accelerating growth, it doesn't even matter if we get the inflation. People say, well, won't the inflation hedge in gold? No. Actually, that's not going to happen because interest rates will take over and the dollar will strengthen. Those are the two keys. So the risk to everything is my macro view. If we get to the soft landing and the Fed doesn't have to cut rates, and we get nirvana, we get the crossroads of nirvana or Goldilocks. Well, the one thing we know is that you don't want to ever own gold in Goldilocks. Okay, so my prediction that this is not going to be Goldilocks. You want to own what's inversely, correlated with Goldilocks and its gold. So that's really what the risk to my forecast is, that somehow we, for the first time ever, 9 months in a row of declines in the Conference Board's LEI did not presage a recession. So we'd have to then say a year from now, well, what do you know? This is the first time this happened. First time that the Fed tightened policy this aggressively into an inverted yield curve without a recession. We're going to say, well, it's the first time this has ever happened. So maybe we'll have to tip our hat to that view that we'll be saying that it's the first time this ever happened. And I think that's what upends my forecast is for these low probability events that take place. I still got to tell you the truth. I still can't believe. I saw in the Wall Street Journal today that 60% of economists see recession this year. And based on everything I'm seeing, I'm amazed it's not like 100, to tell you the truth, or 90. But look, what I'm saying is that a lot of people out there, 40% of economists disagree with me, and that's not a small share. So I don't know, maybe I'm not looking in the right places, but be that as it may, if my macro call is right, it means my rates call is right, and then my dollar call is going to be right. And so lower rates, lower dollar, being long gold, however you want to express it, that's where you want to be positioned this year.
And just to underline this point, it's been a bit tricky in this interview. Usually on this show on Three Ideas, I talk to people about time horizons, but yours is interesting because you talk a lot about if this, then that, which isn't dependent on a time horizon. But I think I heard you say just at the end of one of your sentences there about gold that if things go as you suspect they will with the Fed, that your bullishness for gold is at least months into a year horizon.
Minimally. Like I said before, I think that the risk is that even in a mild recession, we're not going to have much of a recovery. I think the pressure will be on the Fed to ease policy. And I know people can't believe that because of all the inflation that we saw. But the inflation, we'll look back on this period of history that the inflation was really bunched together. And that I believe in Bob Farrell's rule number 1 on mean reversion. And I think we'll go back to the mean. And remember what I said before about how these supply and demand curves are looking. Ultimately, you're talking to an economist. I'm an economist who connects the dots to financial markets. But this is a case where the disinflation is going to be very bullish for the gold price because of what it means for interest rates and the dollar. They are much more, shall we say, powerful coefficients in where the gold price is going to be heading. But it could be longer than a year. I mean, look, you're right. People want to be, are you talking in the next month, the next quarter? Where now everybody did their year aheads in December, but the calendar year is just a quirk, right? And not every race and religion follows necessarily our calendar year, but we always talk about the calendar year. Let's just say that until something changes. So I will turn bearish on gold once we're past the next Fed easing cycle. And as sure as night follows day and spring follows winter, it's just the cycle. Interest rates are going to come down. I cannot believe how many people resist that view. It's as if they are ignorant of the fact that these things move in cycles. I suggested they go read that book, The Fourth Turning. Move in cycles for thousands of years. Okay. And so the interest rate cycle is going to turn. And then when it turns the other way, and maybe that's in 2025 or 2026, and the US dollar resumes its uptrend, which will happen at some point, I'll be moving out of the gold trade. But at that point, we'll be at new highs. So I don't know if this is a 1-year call or a 2-year call. Probably both.
David Rosenberg, founder and president of Rosenberg Research. Thank you for that very detailed, nuanced, and clear vision you've laid out for these 3 ideas.
Thanks for inviting me on, and Happy New Year. And remember, it's the Chinese Year of the Rabbit, which means that that gold is going to be hopping.
Well, what a meticulous macro deep dive treat from David Rosenberg, by far the most in-depth 3 ideas that we've had. And I want to jump straight into those takeaways. His views are predicated on his notion that the Fed will have to cut rates and that inflation will melt away in 2023. His first idea is going long bonds. David's referenced TLT, the iShares 20-plus year Treasury bond ETF. And as you heard him say, he sees returns going to 20% this year. His second idea is aerospace defense stocks. He said he doesn't have a time horizon here per se. He's listening to what governments around the world, including formerly pacifist governments, are saying about investing in defense spending. And he's referenced simply looking at the S&P Aerospace Defense Select Industry Index. And his third idea, another bullish idea, is gold in terms of time horizons. He says that gold is going to new highs in the, quote, coming months and quarters. David sees the dollar continuing to go downward, and the purest hedge against a weaker US dollar in his playbook is gold. He referenced GLD, that's of course SPDR gold shares, and his trade is predicated on his view that the Fed will have to cut rates sooner than later. Of course, if that doesn't occur, that would upend his idea. And we'll see you on the next edition of 3 Ideas.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.